particularly problematic for developing countries. And the problem was the bills of exchange system, the historical system, worked for a small environment, but you couldn't scale it up. And the hope is essentially through digital ledgers and big tech platforms, you might open up the question again. You can actually have this bills of exchange system and more modern systems which rely less on collateralized lending and less bank-centric. You can, scale it up in a bigger scale because new technology allows us to do things which we couldn't do in the olden days. So the big question is, can big tech platforms create an uncollateralized credit system? And that's the question we would like to address in this paper. So in this talk, there's we say there's a fintech vision in it. So you put the payments and the loans in a digital record keeping system, like a ledger, and producers pay for the inputs with uncollateralized IOUs on the ledger. And when producer sells the output, the ledger automatically allocates the revenue to repay the IOUs. So the fintech vision is a simple vision. So, okay, let's just put it on the ledger and allocate it. And it's very difficult because you need to incentivize the use of the ledger, that people use the ledger, or put it differently, you have to disincentivize some alternative payments like the cash, for example. And the cash allows essentially some side trade where you can actually, you take on some credit, issue an IOU, but rather when you sell the product, you sell it against cash and keep the cash and never pay back the IOU, okay? And the argument is what we're going forward is that actually if you have a big tech platform, not a ledger, a standalone ledger, the big tech platform can force the ledger use and set up an IOU system, which leads to IOU funding without default. Because the platform can block the cash trades on its marketplace. So let's think of Amazon and Alibaba ecosystem. It can disincentivize the cash holdings. And if people don't hold cash, then they have to use the tokenized setting. And this is a way to force people to be in the ecosystem. And once you're in the ecosystem and the ledgers automatically, when the payment comes in, automatically IOU is paid off. So you can actually sustain this IOU system, similarly what we had in the Middle Ages in London. And we also showed that this is particularly effective in a high inflation environment. So if the cash or the official money has high inflation, it's more easily to implement. And we also look at other arrangements like banks or crypto or supply chain funding, and they cannot work as successfully as these big tech platforms. So that's what we want to show. And then there's, of course, for policymakers, there's a trade-off. If you have this big tech platform, it has some pricing power, monopoly power. It can extract some platform rents, in particular if it has this walled garden and lack of interoperability. So on the one hand, it can set up some IOU system without defaults, but on the other hand, it can also extract some platform rents. And then the question is, how to keep this in balance. And that's a challenge for the policymakers. In terms of literature, there are different literatures touching upon. One is on ledgers and contracting and settlement assets. That's the first literature we touch upon. And it's what we have differently is here there's a large private profit maximizing institution setting up the ledger. So it's not like in the other papers, particularly in Cocha La Crota, where there's a government setting up a ledger. And, here there's an incentive constraint, so you have to be incentivized to use this ledger and don't use any side trade. Then it's also related to this literature on uncollateralized finance, and I will come back to this. Here we address more macrofinance model and of platform finance ecosystem. And then, of course, it touches also to some digital currencies and currency competition literature. Here it's centralized. So it's not a decentralized blockchain technology, but it's a private digital currency provided by a trading platform. The connection to the trading platform plays a particular role in our setting. So the way I want to proceed essentially is that I first start with a simple real two-period model. And I will spend most of the time in this two-period model to illustrate the main thing. And then I move in the next section of the paper, we analyze a monetary macro model And we go into this fully fledged macro models where we can also then study the inflation on the official currency and the fiat currency interacting with the IOU system or the tokenized IOU system in the model. And then finally, I will conclude. So let me start immediately with the two-period real model. There are two types of agents, savers and producers. The two goods, two types of goods, a storable endowment good, which can also serve as a commodity money, and a perishable output good. Okay, so the endowment good you can store and pay with it in the next period. You can also lend it out and essentially use it for production and have some output good from that. So in t equals 0, the savers are born with endowment goods, and each producer can use one endowment good from somebody else. He has no endowment good on his own to start a project. So the producer must issue some IOU to buy the input goods, but he has no collateral. That's the assumption we have here as well. And then the producer something, then the output is produced. There's Z or Z output produced between 1 and 2, so let's say 1.5 output goods. And the agents, they cannot consume their own endowment good, or they can, but they get no utility from that, or their own output good. So there has to be some trade at t equals 1 for this trading. So agents need to trade to consume the goods.
The quick thing, Markus, on that, the perishability in this 2 period is not critical anyway, no? Because output good is produced in period 2, and there's no further periods. So there's no reason to save or anything. Maybe in the dynamic.
Yeah, yes, fair enough. Yes, that's a good point. Yeah, because it's over. In later in the macro model, then it will be, but here in the 2-period model, yeah, that's correct. Yes. Good point. But what's important, I think we just want to stress that the endowment good is storable because we want to use it as a commodity money, essentially, in the real model. Good point. So let's look at the information frictions and enforcement frictions. So the enforcement frictions are essentially the key emphasis here. So if first best, the planner reallocates the endowment goods from the savers to the producers. The producers start a project. And then there's the output good produced by all the producers across the agents. And then they swap their output goods in order to consume. That's the first best in the simple model. The frictions, I just want to emphasize the frictions. So in our setting, the agents have public identities. So that's, not like in Bitcoin or something. It's more like you think of as ADA system in India, or think of any other, Alibaba payment system and so forth. So, but the actions are private. The second thing is the agents cannot commit to pay back the IOUs. And there's no public legal system for contract enforcement. Okay. So the producers cannot issue IOUs privately to savers because they will not be repaid. And the question is, can we introduce a privately controlled record-keeping system in this ledger and get IOUs issuances and to achieve the first best production in this simple market economy? So what's a ledger? So a ledger is simply a digital record-keeping device, a system like in Lakota 98, money as memory. It can be token or asset-based. The wealth held by different agents is using the ledger. It also records the contracts, instructions for executing transactions, conditional on information, and the information, it also contains information that has been provided to the ledger. So that's what we consider as a ledger, the record-keeping device or keeping system, where all of these things are recorded. And then because it's recorded, you can also write contingent contracts on that. And I want to contrast 3 economies in this 2-period model. First, say, okay, let's have an independently privately operated ledger. And say, okay, is this viable? There's an entity which says, I'm setting up a private ledger for you to use. And the second economy is that I say, oh, no, it's not an independently standalone ledger operator, but it's a tech platform which sets up the ledger and operates this ledger. So it's not independently operated, it's just a tech platform, a big tech platform doing it together. And we will argue that you need that. The first one will not work. And then the third economy is where you have a public ledger recording this think of the broad FedNow system or CBDC, where we don't really touch upon on the central bank balance sheet aspects of CBDC, but more on the ledger payment providing aspects. Okay, these are the three economies we want to contrast. So here is the independent ledger economy, the first economy, and the trading and the record keeping. So at t equals 0, producers can issue an IUs recorded on the ledger. So the IU promises, some capital R larger than the goods at time equals 1, and for each endowment good given at t equals at 0. So the savers give an endowment good to the producer. Producer promises R goods back and issues this IU. And the savers, of course, who have to decide, okay, do I lend my endowment good against an IU to this producer, or do I simply keep it and store the endowment good? Okay, and then I use this endowment good as a commodity money essentially next period to buy with this, or do I use subsequently essentially IU to purchase something with it? Okay, so at t equals 1, that gave it already away. There's a competitive market for trading endowment goods, output goods, and IUs. So some people have endowment goods if the savers stored it in endowment goods. If they lend it out, then others will have some output goods, and the savers who lend out, they have IUs. And there's a ledger settlement at t equals 1 that's centralized and can be made with any of good or IU. So the ledger arrangement can be done with all of them. Or there's a spot settlement, which is happening instantaneously, like when you pass on some cash. So finality of payment happens instantaneously if at least one agent has the endowment good. So the endowment good you can just use as commodity money, and the endowment good is essentially universally liquid, usable for all settlements. Okay. And the ledger trades, what's important about the ledger trades, it automatically settles IU. So if you make a payment and then it goes to the ledger, and part of the payment is immediately used to pay off the IU, and the rest then goes to the producer. And the spot trade allows the agents to default. So that's the big difference. So one big difference is, or that's the big difference. I make a payment over the ledger. I don't know, let's say X amount. Some of this X amount goes immediately to pay off the IU, and the other thing goes to the producer who sells it. And the spot trade, there's no automatic settlement. It's a little bit like in Princeton when you take a mortgage. Princeton University gives you a mortgage if you're an employee, and you can't default on this mortgage because it takes it out of your paycheck. So Princeton University takes it out of the paycheck immediately, so there's no way for me to default on my mortgage in this way. If it were a spot trade, then actually the agent can default. And of course, there's a terms of trade. The question is, if I'm selling a good and I get a payment where immediately IU is paid off, that's fine with me. But if I get an endowment good and I can default on my IU, I might actually give you a better price. Okay, so the price for the endowment good, for the terms of trade of 1 towards the P is different, is probably advantageous towards you compared if you give me an IU, knowing that the IU will be immediately settled and I only get the remaining part of it. Okay, and there's if it gives me the option to default, or you the option to default, I might offer you a better price. Okay, so that this terms of trade effect will turn out to be very, very important. Okay. So here's a picture of the whole thing, what I just told you, that t equals 0, there's the producer. He has an idea, but he has no goods. He can buy some input goods from the saver, and then he gives them IU to the saver. And then in t equals 1, the producer has now produced something. He can sell the output good to the agent. And if it goes through the ledger, he makes a payment, as I said, to the ledger essentially. And the ledger says, okay, part of it is just repayment to the IU, which goes to the saver, this guy who got this IU. He gets the repayment of the IU, and the other part goes as profit to the producer. That's why this blue line you see is thicker and splits up in these two thinner blue lines. Okay. And that's a vision that the fintech guys have in mind, saying, okay, we just have to set up a standalone ledger and you can actually do all of that. So moving all payments and contracts into one ecosystem ensures IU payments. And the question is this sustainable, or is this a feasibility or not?
So you didn't put the side trades on that picture.
No, it's coming. It's coming.
So that's on purpose. Okay.
Yes. So this is like a straw man.
Okay.
So the question, what can go wrong with fintech vision? Essentially, here's now the side trades, where essentially I can actually have this endowment good. So I can pay with the endowment good. By paying with the endowment good, I do this private spot trade. And then the producer can default on the ledger, i.e. on the saver. Okay, that's your side trade. And so that's essentially the endowment good payment or the spot payment. And then this allows the producer to default. And actually, a producer might say, if you make a payment with endowment good, actually, it's better for me because it allows me to default, so I give you a better deal. Okay. So this guy might prefer to have this endowment good in order to pay with endowment good. So that's why we think having this first economy where you just set up a standalone ledger because of the spot trades or the side trades is actually not possible. And what's the reason is that these endowment goods are universally liquid. Okay, that you can use it for any of these payments, but it also makes the side payments very, very simple.
Okay. Markus, yeah. Yes, I think also what's interesting here, so the producer is the borrower, and then he borrows the endowment good, but then he gets the output good as in the period one, but then he has to trade, so he cannot consume that good, so he has to trade, and this market for the endowment good. That's where the producer will evaluate the decision whether to default or to go to the ledger and trade, using the ledger and repay the loan. So I think what's interesting is the fact that these default decision will depend on the relative prices between the output good and IOUs, because he can also buy. So if he buys IOUs, he has to go to the ledger. So the relative price of output goods will depend on this. The decision. I think that's kind of an interesting thing, which is kind of different from Couture Lakota, where the outside option is always exclusion to autarky. So that's something.
Yes, that's a good point. So I should have made this point. Thanks. So it is really, because which good you pay with, you get a different price, essentially. Very good. So that's essentially, that's just stating, I mean, it's not very formal, but just saying in equilibrium, no agent accepts I. So knowing that these guys will default, then the producers, the savers will not accept the IU. So everybody will have endowment goods. There will be no production going on. So everybody with endowment goods can just swap the endowment goods later on, but there's no production. There's no agents accept IUs. There's no production taking place. So if other agents are producing, then it's optimal for an agent to store the endowment good, purchase the output good, offering an unrecorded spot trade, which allows the seller to default. And the main reason is that he gets some favorable terms of trade. Okay, so if you say, I offer you an endowment good or commodity money, you get a better price. And because of this better price, it actually makes for the guys initially saying, I don't even lend it out, I keep the endowment good. And that kills essentially this equilibrium where you would have some lending through IUs going on, and hence there's no production in the simple economy as well. Now, the question now is, and if you look at the data, so we found this paper by Rishab and Schäublin. They studied the fintechs trying to do this in India. And what they find exactly that what's going on in this model is that they find that non-performing borrowers drop their non-cash sales. So once you take out a loan and say, I will then, through the digital payment system, I pay back my loan, then actually the non-cash loans, the digital sales is actually dropping off by 18%. Okay, it's exactly the same, essentially, mechanism, which we describe in a simple model. They are described already in this empirical paper. And here's the text. So they try to divert, essentially, away from this online platform towards cash in order to avoid or to allow, essentially, make default more possible. And the default rates are going up. Now, the question now is, okay, this doesn't work. The simple fintech vision saying we just set up a common ledger is not really working. So can we do something else? And can a big tech platform rescue the fintech vision? So it's not only a standalone ledger, but it's a platform where trading happens on this platform combined with a ledger. Okay. And so when does this work? Okay, so we now move in the second economy, where the platform controls trading and ledger. The platform is controlling both trading and the ledger. I have the same environment as before, but now at T=1, there are now two trading technologies for connecting goods traders. There's a private platform that is controlled by a profit maximizing operator. So it's a private platform. And they can also make the trades off the platform on an open public marketplace. And in this two-period model, what we assume initially is that the agents find platform trades with probability eta, so you will trade on this, and probability 1 minus eta, you trade off the platform. And it's exogenous, it's just fixed, it's randomly drawn. We endogenize this in the bigger model, in the monetary dynamic model. Okay. For now, you just take it for given. Say, okay, probability eta, you trade on the platform. Probability 1 minus eta, you trade on off the platform on the public marketplace. And the platform provides the trading technologies and the settlement ledger, so it's a combined entity. And it prevents agents from making payments using input goods, or there should be this endowment commodity money good, the endowment good. So what happens is that if you store the endowment good or this input good, it's not universally liquid anymore because you cannot use it, because the platform says you cannot use it on the platform. Okay, it segments the market. So the platform has now the power to segment the payment. And say, if you have stored this endowment good and want to pay with that, we don't accept it. And then you're stuck and say, oh, but I still want to, I'm randomly drawn to trade on the platform. I still want to consume, and then you're stuck. And of course, the platform is also choosing a markup. It can extract some rents from choosing a markup. It can also, provide a subsidy, so the markup could be negative, just to keep sufficiently many people on the platform. Okay, so let me go to the picture again. So this is the same as we had before now, but we have a platform and a ledger. And as I said, a fraction of the fraction eta of the sales go through the platform, and a fraction 1 minus eta goes directly off the platform. And then the payment happens. So what happens, the payments, if the payment works through the ledger, then there's a ledger payment going on, and the ledger, as before, repays the IOU, and what's left over is then the profit for the producer. Now, there could be a side payment as well, which was this red dashed line, but under certain assumptions, and I will show you if this eta is sufficiently high, nobody really wants to store the endowment good anymore, okay? Because they want to go through the platform. So nobody has any endowment goods, so this is actually not really feasible anymore. And because it's not feasible, everybody will produce, and we actually in the good equilibrium. So savers do not store the endowment goods anymore if their lower liquidity outweighs the higher value. Okay, so let me go a little bit more formal. So what's the intuition? So the platform ledger crowds out the cash trades, or should probably call it endowment goods or commodity money trades. So imagine you are a producer looking to sell your goods privately for cash or for this endowment good and default. But you can only do this if you have counterparties who have stored a suitcase of cash. So there's enough cash out there. But if everybody else said, okay, I don't store it, I go and lend it out and get IOUs, everybody has only IOUs, you cannot find anybody. And hence, it's for you, it's not worthwhile really to also do that. So your ability to default depends on other agents' choice of the payments technology. It's not your choice. It depends what others decide to do with whether they save the endowment good or they're converted into an IOU. So even though the platform only controls some of the trades, in this case eta, it can disincentivize all agents from holding cash or this endowment goods and block this way the default, okay? By blocking the use on the platform, so you essentially make the cash or the endowment good less universally liquid, and this way you can actually enforce that everybody is going through the ledger, and then there's no default anymore in this
Markus,
system. Yes?
Yeah, clarifying, I think it's also optimal for the platform operator because he could accept in principle endowment goods, but it's optimal to block.
That's correct, yes.
So it's part of an optimal decision too. Okay.
That's a good point. Yes, yes. It's the optimal thing for the platform to do as long as the markup is positive. No? But if the parameters, the way we have picked them, it's always the optimal thing to do. Otherwise, the platform has no big role to do. So the platform itself not only facilitates trading, that's here it's assumed, but it allows the whole production and the whole credit system and everything to operate.
So I have a question too. So you talk about something in the paper which threw me off a little bit. So if the ledger, let's go to the first part, and let's suppose that we only have the ledger. The ledger gives a guarantee that it's going to pay the IOUs in full. So if agents believe that, the savers believe that, they're going to then sell their endowment good for IOUs. And in period one, there will be no endowment goods. There will be only output good. And by assumption, output good cannot be traded in the spot market. So everybody will have to go through the ledger. So is it the critical thing, the trades, or this, the controlling the trade, or is it that being able to give the guarantee in a way to guarantee?
So we have this. So there's this. Okay, the guarantee is there in order to avoid this particular knife edge equilibrium. Okay, once you give this guarantee, you can avoid that.
Yeah. So you think that's kind of like a knife edge case?
Yes. So because the big driving force here is that if you pay with endowment good, you get a better price, no? Because you allow the seller to default on its IOU. And that makes it so much more attractive. Of course, if you know for sure there's nobody out there who has any cash, then this other equilibrium also exists. But as soon as some are out there, then you might want to change.
So if you add some noise or something, you think this will go away somehow?
Yes, yes. So, but we put this guarantee in it. So this also does the trick, essentially. If you don't have that, there might be this other equilibrium thing that nobody ever goes for.
Right. I mean, I thought this might be important because to say that really controlling the trade together with payment is important.
Yes.
Shouldn't be another kind of.
So we want the result that, controlling the trade and payments, that's the important thing, except for this knife edge case.
Okay.
Yes. Yes. So let me just go a little bit more formal. So what I want to, so you see this again, here's just the details are in the paper. You can see, do you want to purchase the IOU, essentially lend, and then allow the producer to produce? So, or do you want to store the endowment? So if you store the endowment with probability 1 minus eta, you're off the platform, then you're getting buy it at a very favorable price because the seller can default on you. If you're matched on the platform, you're lost because nobody wants your. Then the platform says no, but you can't pay with that. It destroys the universality of the liquidity of the endowment good. So that's what with eta is equal times 0. If you purchase the IOUs, i.e. you lend, then you have an IOU, then you can buy at the price of Q. Of course, if you go on the platform will also eat up some markup. So you get 1 minus the markup. So that's what you get on the platform. If you're off the platform, you get this whole Q. Okay, that's the incentive constraint for you. If this is satisfied, then everybody, or you and everybody else, will actually lend and purchase the IOU and doesn't store. And at the end, there's no cash out there. So in order to make this sufficiently, the incentive constraint hold and everything work out, this mu has to be sufficiently low. And that's what's shown here. And this essentially is the condition that we have in this equilibrium. So mu has to be below this mu bar. And you can see if there's higher productivity, then this mu, the production is more productive relative to storing. So the Z is higher, then this mu is going down. And also if eta is higher, then that's the same thing. The mu is going down. So the critical mu is actually, given by this expression here. So the platform can essentially disincentivize endowment good storage while still extracting a rent. Of course, it can still charge it has to stay below the platform. The platform will push it all the way to mu bar to extract all the rent possible. The markup the platform will charge will push it up all the way to the critical markup such that the incentive constraint is satisfied. Okay, so and essentially for sufficiently large ethers, then the markup, this will be a positive number. So if they're very low ether, if ether is very low, the platform does not set up a ledger because then it has to set up, in theory, a markup which is negative. It has to subsidize the platform, and it wouldn't do this in equilibrium. So that's essentially why this ether has to be sufficiently high in order to satisfy that. But it doesn't have to be the whole thing. It can be part of that. But if ether is very low, then it would have to subsidize it, and the mu would be negative. So put it differently, only a dominant trading platform, i.e. a large enough ether, will set up such a ledger. And by doing so, it expands the contracting space and allow for all this credit arrangement without the need of collateral. No, there's another, of course, there was an India example we had before. Now we have a Chinese example where we have this platform going on, this Alibaba ecosystem. You can relate it to this. It fits less perfectly than the Indian example, which is spot on what our mechanism is. Of course, we all know Alipay and WeChat Pay in India. There's a lot of credit arrangement going on. So this points to the same direction, that if you have a big tech organizing this ledger system, then actually it is possible to get this off the ground. And there are huge amounts of loans given what this paper documents. It's mostly given to first-time buyers, young buyers without any credit history, without any collateral, mostly in rural areas, mostly very short, small loans. So it's possible, totally uncollateralized, which you can get set up this way. So the third,
Markus,
yes.
Can I just a quick summary of the results so far? So if you think like comparing to Kocherla-Kota, he only has the ledger, and then we can see in your environment, because of the site rates, the ledger itself is not sufficient for credit to emerge, and then introduce the platform, which is essential, which is important to control. It's optimal. I mean, it's essential to control both the trade and the payments. Then you can implement the credit equilibrium. So
that's very nice. Yes, that's correct. Okay. So here it's essentially in Kocherla-Kota, you just forced to be on the ledger.
Yes,
here, these guys have this side opportunity, and so have to incentivize you. And one way to incentivize you is through this platform arrangement.
Yes, and but even if you think about but if you are allowed for the side trade, so the ledger in Kocherla-Kota collapses, because that's that's your first result, basically saying if you have the side trades, so the ledger.
That's correct. So now you can say, okay, why don't we introduce a public ledger option like a FedNow, open to everybody, not just to the banks? It's a little bit going to Kocherla-Kota in a sense. And also can think of private payment CBDC. Let's put CBDC in quotation marks. So the government offers a public ledger technology to settle trades. And the options are the two options. You can say have a private payment CBDC, only provides the payment settlement and respects agents' privacy. So there's agency privacy going. Or you have a smart CBDC, which also records and settles contracts. Okay. And what we are saying here is essentially that if the government provides a privacy-respected payment ledger, that's the first option, and forces the platform to accept payments through the public ledger. So essentially now the platform cannot destroy the universality of its payment. So the public, you can always make the side trends. Then there's no equilibrium with full contract enforcement unless Ether is one. Okay. So that's essentially comes directly after the previous result. Now the platform, that kills essentially the platform's power to destroy the universality of the side payments. The CBDC, this private payment CBDC, reintroduces the universality again of the liquidity of the side payment, and that kills essentially the whole arrangement. Now, if the government says, on the other hand, we introduce a CBDC, we call it a smart CBDC. If the government provides a smart ledger and eliminates endowment goods payments, blocks commodity money in a sense, then all contracts are enforced and first best productions achieved. That's essentially going back to the world where you can actually do everything on the ledger and you kill essentially the side payment. That's the other extreme. And the bigger picture here is that, so it matters a lot how you design such a CBDC payment system, what privacy regulations you put on it, and you can go one way or the other way. It has huge implications then on, not only the payment system, but also on the credit market. I think that's what we want to push here. And the trade-off is the efficient private payment system versus efficient contracting system. Do you want much privacy protection, or do you want a very efficient contracting system? There's some trade-offs in this dimension. Now, more generally, you could say, why not other ledger providers? Like what many people say, what's about a credit bureau and so forth? So in our setting, what we don't have there's a huge amount of literature with repeated borrowing and so forth. We don't have this. We deliberately said, there should be no repeated borrowing because we wanted to study the other case where there's no repeated borrowing. Nobody has a credit history and might not come back to the same bank to that. The other thing which I find very interesting, so far we made the Z productivity parameter constant. So you knew already you take so many endowment goods and get so many output goods, but this could also be a random number. So production could be risky. So some aggregate productivity risk. And what's nice about this ledger system, if you have ex ante onboarding to the system, what matters is the expected value. And then you can not only make the payment automatic, but you can also make a contingent on the realization of that. So it allows risk sharing. So if you have this ledger arrangement such that people participate there, what's important is expected Z to get the onboarding going. And then you have through the ledger, you have some risk sharing arrangement, make contingent payments on this. So this can be generalized much more than just having some debt arrangement as we have analyzed before. And finally, I should say that of course, we have all goods are not the same, but there's no different sectors and different aspects to it. You might think, who can run this big tech platform? It could be done by a big tech platform, which is like Amazon, running all the goods and representing broadly the consumption basket we have. Or it could be an industry-specific automotive or textile industry, and they run it for their industry. But of course, if you go for the second, they are less ideal to run it, because then there's an exchange rate risk of their IUs with what's trading is going on within their own industry and not the whole consumption basket reflecting what's going on in the whole economy. So the broader the big tech companies, the more it reflects and captures the whole consumption basket of the citizens, the better it is as a big tech firm to do it. So in terms of lesson of the...
Yes? A clarifying thing, for the random Z, so you have the idea that this Z is, the output is observable, like it's random, but we can observe how much the producer...
It's observable, exposed, yes.
I see. If not, then there will be another kind of layer of, I guess, some sort of like...
No, then this would be, going back, this would not be an IU, it would be some risk-sharing contract in a sense. And then you put it on the ledger, and then when the transaction occurs, you see at what price, and then it goes, the split up between the IOU repayment and what the producer gets is then a function of the Z realization. So you put already a smart contract, so it's, or this contract arrangement is already put on the ledger. But what I think the important message we want to get across is, in order to, the same argument we say, in order to get people locked into this ledger system, together with the platform, the ether has to be large enough, you lock them in. This can be done for a fixed Z, but the argument extends exactly to a random Z as well. Okay. And what matters, whether you want to initially start with this whole thing, depends what the expected Z is. And then you get then this risk sharing going on. So there is some risk crop sharing arrangement. You can set on some risk sharing benefits you have on this on top of it. It's not only credit provision, it's also better risk sharing in a sense. Okay. So in terms of lessons, of course, that's just a summary. So the ledger is only useful if it's backed, because unlike in Lakota, it's not forced. You have this side payment, so if some crowding out from the commodity money eliminates. So, but the big tech can actually crowd out and make the commodity money less useful and say, oh, you can, if you buy on my platform, you cannot use this commodity money. And so it makes the side risk less useful. And on this way, you can actually have some uncollateralized IOUs going on, enforcement going on, even without repeated interactions. Okay. But what's important is that there's to be a dominant platform. So only large platforms can do that. And so there's a natural monopoly. So if you have 10 platforms competing, it's much more tricky. So there's one large platform controlling the ledger, or sufficient, or two of them. We will come to this later on. And as I mentioned last, there's a trade-off between, having privacy and also having contracting efficiency. Now, this was the two-period model. Now, let me move to the dynamic monetary macro model. And so what do we do in this one now? So we change the models in various ways, but we also would like to have the macro implications for using a platform-backed IU system on the currency itself. Okay. So we introduce a settlement using currency. So there's government cash in the spot market. So it's not commodity money anymore. It's that government cash is in the spot market and instantaneously settles. Finality is there. And then there's an IU on the ledger. And so we introduce a secondary market for IUs and endogenous terms of trade. So terms of trade were endogenous before too, but there were always one price was the other price. Now it's much more endogenous. We will see in a minute. Then we also have an infinite horizon setting. We have an OLG setting. So why? Because if you want to have a currency, a fiat currency to be valued, you need this infinite horizon setting. And also want to discuss dynamic feedbacks. Remember, we assumed this probability eta, you go on the platform, 1 minus eta off the platform. This was exogenous. We endogenize this now. So you can actually say if the markup is too high in the platform, I might switch over and trade off the platform. So the endogenized platform ability to back the ledger through trading advantages is then endogenized. And we introduce some intermediaries. These are funds that helps the aggregation of the results. And essentially, you can outsource a portfolio choice to these funds. And finally, we also allow flexible project size. So far, it was, if some input good or some endowment good produce Z output goods. And now it can scale it up, but it's a concave function. So when you increase the markup, you also, not only do you drive some guys off the platform, but there might be also, you scale back the aggregate output in the whole economy. So what's the setting? So it's a discrete time infinite horizon setting, OLG model with one consumption good. So there's only one consumption good now. This good does everything. You can use it for production as well. There's no endowment good anymore. And here are the guys, the producers. So you're born at time 0 without anything, but with an idea. Okay, so you have a technology. You can take some goods, X goods, and then you produce output, and that's your production function. As I said, alpha is smaller than 1. This is your concave output. But at the next period, you produce this output. So at age 0, you try to raise some funds in order to buy some number X goods. And then you produce something when you're at age 1, you have this good, and then you can sell these goods. You can consume, you don't consume your own goods. You sell it and buy some other goods and consume, and you can repay what you have borrowed at time 0 or default on the IU. And also, you still live for another period. You want to consume in the next period, so you also save something for the next period. So essentially, when you're born, you become you're a borrower. And when you're at age 1, from 0 to 1, you're a borrower. From 1 to 2, you're a saver. Okay, and it's an overlapping generation model. So everybody is in the first part of their life, they're borrowing. And the second part of their life, they're saving. Okay, but everything is endogenous, a general equilibrium closed model. Okay. Now, so perhaps you can show this in the next slide. Oops. So here, look at generation T. That's, you're born, you borrow from the previous generation, you issue an IU, essentially. Then you have the output good. Some of it you pay back. So then old generation, they can consume what you pay back. Some of it you trade in the current period to consume for your own thing. And some of it you start saving. So you lend to the next generation, which produces something, and then you get something paid back, and then you consume again when you're old. Okay, so everybody lives for 3 periods, first being a borrower for 1 period and then being a saver for 1 period. Now, in each period, you have to decide, do you want to trade on the platform or off the platform? Okay, and it's not a probability thing anymore. It's a discrete choice. You choose one or the other one. So we don't allow a mixture of things. You have to be on one or the other. It's a discrete choice. And the way we model this is a traditional discrete choice setting where we have, you get an amenity shock, which is a gamma distribution. And this gamma is essentially the elasticity of substitution at this particular age you are. So everybody gets their own shock. And it's how sensitive you are. If the markups goes high, the price gets too expensive on the platform relative. So on the platform, at some point you will switch over and go off the platform. Okay, and then of course the platform might be more efficient in matching. We also model this as part of the amenity shock. Okay, but the gamma essentially is this elasticity of substitution at this particular age. So at each age you face a different shock. Okay. So that's essentially how the model works. And in terms of currencies, we also have a difference. So we have 2 payment technologies now settled using financial assets. So we have a spot transaction. They have a resource in advance constraint, like a cash in advance constraint. If you do the spot transactions, you have to hold these things in advance. Payment must be made using public money or barter. So these are the cash goods or the commodity goods, similar. It's where you have to, in advance, you have to put some resource aside. And the other thing is on the ledger, there's no resource in advance constraint. Okay, we wanted to mimic this, what's going on in the real world. So the agents can pay on the ledger using IU claims to non-risky future income on the ledger. Okay, so it's a ledger IUs or credit goods or digital bills of exchange. Similarly, but the key distinctive feature between the spot transaction is you have to hold it, before this, and the others don't have to hold it. Okay, and then you have some price, you have some real exchange rate between the IUs and money. And essentially, you can think of this epsilon or this price exchange rate as a platform goods. The platform is the numeraire, and this is the price of the platform. Now, we also have to solve now because you're saving, and you're borrowing in the first when you're young, or from 0 to 1, and you're saving from 1 to 2. And so there's a return on this borrowing. There's a return from holding money. And then there are some deposits, and there will be some loans if you take out this loan or this IU and all these things. So there are different rates, and I don't have the time to really go in all the details but essentially you have the whole economy. But let me just jump a little bit because I'm running out of time. So you can, as I said, you get some inputs from the previous generation, you pay with the IUs. And there's a fund who does all the fund management. The fund essentially issues deposits. It has some cash. This is the official money. The IUs, which are floating around. And they're also in this model, the platform itself is a profit-making enterprise, and it's also owned by the citizens in this economy. So platform shares are essentially also some assets. Okay, all of these 3 things are assets, which are the proportions are managed by all the agents are the same. The funds manage this for you, and they issue these deposits, and you can do the things then with the deposits. Let me jump over this math. Let me just illustrate what's going on. What we have here is you have the markup by the central bank, by the platform. So you have higher and higher markups. So it's from 0 to 10%. And what happens if the markup is going up? What you have is that with a fixed interest rate. So let me fix. So the blue dashed line is, let's assume we have like a small open economy. The interest rate is fixed. So how much you can borrow is fixed, because you could also borrow from abroad to get some funding from abroad. So it's fixed by a fixed interest rate, this blue dashed line. Then as the market goes up, the buyer says, okay, I don't want to go through. So when you're young, you're buying and borrow and you're buying. You don't want to, as the markup of the platforms, that's a higher and higher markup, is actually the case that the fraction which go through the platform, eta 0, is actually going down. Okay, the higher the markup, the fewer want to go through the platform. Similarly, when you're at age 1, when you want to sell, the higher the markup, the fewer and fewer people want to go. And then when you're in age 2, you want to buy again, it's also the case. And what's interesting, essentially, and as the markups goes up, it is the case that actually total output is going down. Now, if I close the economy and say, oh, it's not a small open economy, but the interest rate itself is actually affecting the general equilibrium as well. So what's going on is, as the platform increases the markup, the equilibrium interest rate is going up. Okay, and why is that? The reason is, if the markup goes up, people tend to get off the platform and go for the cash trade, or going for paying with cash. So they don't lend anymore, because by going through the IU ledger system, I implicitly part of the lending business, and suddenly there's not so much lending going on anymore. That not only kills off the output, but it also locks in people. Okay, so let me just say, so if the markups go up, it encourages agents to trade off, to go to off the platform. That has some effect. So the interest rate is actually going up. So if they're on the platform, when they're safe, they automatically are lenders to the borrowers. If they're safe with cash, then they don't lend. They're just sitting on this cash, on this fiat money, but there's no lending going on. So if the interest rate, and hence the interest rate is going up and loan supply is going down. So they're sitting on cash, loan supply is going down, and the interest rate is going up. Of course, this whole effect is a little bit mitigated. If the interest rate is very high, some people say, oh, I come back to the platform and do some lending because it's so attractive to just earn this interest rate. Okay, but the first order effect is given by this. The higher markup encourage agents to get off the platform, then they hold more cash and they reduce their loan supply. That increases the interest rate. The fact that the interest rate is higher might bring some people back saying, okay, I can actually earn this high interest rate instead of getting no interest on the cash holdings, on the fiat money from the government. That's essentially pushes in the other direction, but that's the first order effect, is the first bullet point. And this also changes, of course, the exchange rate of the platform, so the price of the platform. And that's what you see here. So it goes, and that brings the fact that off the platform price is going down. That also brings people back onto the platform. So the general equilibrium effects. So what's perplexing is the general equilibrium effects actually made the whole thing go in the other direction. Okay, but the very important thing is that if you just think about regulating platforms and look only at the markups they're charging and all this, it has not only implications on the product market, but it has huge implications on the general equilibrium interest rate as well. Okay, so charging a higher markup leads to higher interest rates. Of course, then it makes the fiat money on the margin also less attractive. But overall, the first order effect is that the interest rate will be significantly higher. So let me just say, of course, we also have the incentive constraint we had in the two-period model. We have here 2. Now we have to deal with all these value function things. But what's important is there's a double exclusion in this full model. So if you accept defaulting agents to be on the ledger, then so an institution or this fund is excluded on the platform trading. So I can say, okay, if you default, you will be excluded to be on the platform. on it, but it will also be the case you will be excluded from accepting ledger IOUs. So you will not only be excluded from the trading on the platform, but also from the IOU market, the credit market. Okay. So I don't know what's so do you have to save some time for the discussions too, or let me just make one more result. Sorry, if it's okay. So what's interesting is the platform problem. So the platform itself is choosing, of course, it's an optimal markup. The platform is owned by the household. So what matters are the SDF of the households. These are the future profits of this platform. And the platform is choosing a stream of future markups into the future. And it takes into account the IC constraint of the agents and also the equilibrium prices resulting from that. And what's interesting is that what you have depicted in this figure is the growth rate of the public money supply. So how much inflation essentially is in the cash, the alternative. And you can see if you live in a high inflationary environment, so there's 5% even higher inflation, then actually it will actually be easier for the private platform to set itself up. So let me just show you what's going on here. So there is an optimal markup. That's the blue dashed line. Okay, and you can see the optimal markup, the less competition there is from the fiat money to make the side trades, the higher the markup, the optimal one for the platform. That's the blue line here. So the more higher inflation environment, the platform in theory can set up a higher markup. But there's also an incentive constraint to make sure that everybody is not defaulting. So the non-defaulting constraint, that's given by the red dashed line. So the markup has to be below the red dashed line. So the optimal one is below the red dashed line, except if the inflation is above 3.5% or something. So the equilibrium markup is given by this expression, by this blue line, and then it moves over to this red line. Okay, that's the equilibrium markup. But the important thing is, if the inflation environment is very high, the incentive constraint binds, and that determines then the markup. If you're in a low inflation environment, the ledger is still set up, and then it's the case that you're in this environment and the platform is optimal and doesn't have to worry about the incentive constraint. If you're in a low inflation environment, the public money might be so attractive that in order to sustain it, you need actually a negative markup, but the platform doesn't want to go for a negative markup. It would be loss making for the platform. So it's essentially setting a zero markup, and the ledger is not set up. So there will be no platform active with this ledger arrangement, and so it's not set up at all. So there might be a platform where there's still trading going on, but not in combination with the credit arrangement. So there are additional lessons from the macro model is that in general, equilibrium interest rate is actually locked in by the agents to the platform that determines the interest rate. So higher markups encourage agents to trade on the public marketplace, means off the platform. This increases the demand for cash, which limits the loan supply, and that increases the interest rate. And that's essentially leads to a much higher interest rate. It's partially offset. The high interest rate makes then, of course, being on the platform again more attractive, but that's only partially offsetting this. You can also show that, with our cash storage option, the producers are locked into the ledger IOU system. And the final result essentially showed that if you have a loose monetary policy, that increases the profitability of the IOU system, i.e., if there's a higher money growth rate, the return on money is lower, might be even negative because of inflation. So money is less competitive as an outside side payment option, and you can actually set up the ledger, the IOU ledger, with the credit arrangement more easily. And of course, you might say this also allows the platform to extract more rents. So it might be, it can also charge higher markups and extract significant more rents. So we have a ton of extensions, but let me conclude. We have competition between two private platforms where you can also have relations to that. So let me conclude. So there's this fintech version out there. We can just have to set up a ledger and everything will be fine. We say, oh, we need actually a big tech platform to get this going, to have the credit arrangement going. And the question is when can we do it and when is it attractive enough for a big tech platform to do it? So one thing is, of course, the inflation has to be sufficiently high. If it's too high, then there's too much rent extraction. There's also policy and regulatory implications between this platform rent extraction and the credit extension. How to design the CBDC payment system matters a lot. You refer a lot of privacy. Has very different implications. You kill essentially the credit market, or do you want to have a very much a smart CBDC ledger where it's very focused on credit extension? I didn't have time to talk about competition between two private platforms, but essentially what comes out of that, there will be one single ledger, there will be one platform offering a ledger for both platforms, and they have to find an arrangement with that. And the macro lessons were that higher markups raise equilibrium interest rates, so there are interactions between the goods market and the credit market. And monetary policy has huge implications as well, because it makes it more or less attractive to use the side trades, and incentive constraint becomes more binding or less binding. And let me leave it at that. Thanks for your attention.
Thank you very much, Markus. Just a couple of comments from our panelists, if they have. Emre, do you have any comments?
Sure. Yeah, I actually have a few questions. One is actually if you had matching risk, you don't have matching risk here, right? So when I go to the platform, I always find a trading partner because you kind of model
Yes.
competitive market. I guess if there was matching risk, that would make IOU even a better thing, because if I come with money and the money, there's inflation, that would, I take the risk that I may not use the money. But if I'm borrowing, I'm buying on credit, it's more efficient.
That's a good point. So we had a matching market before, and in the two period model, it makes the analysis less clean than it
Also,
is.
I guess there it's not so interesting because you have commodity money anyway, so it's like maybe
Yes.
interesting in the macro thing. And
So
then,
we moved away from the matching, moved to a competitive setting. We think it's a cleaner setting. Perhaps Jonathan can come in too. Or,
so the other thing I was going to say, why do you need these agents to live for 3 periods in the macro version? Why not 2?
No, we want that they're borrowers initially and then savers subsequently. So otherwise, you would need different type of agents, some borrowers and some savers. But here, they're just different in terms of age, but everybody is the same. They initially borrow, and then, in the first part, from 0 to 1, and from 1 to 2, they're savers. And everything is closed, and the credit market is closed. So the previous generation savers has to be equal to the borrowers from the current generation.
I'll have to think about that. But I actually have one last thing, which is in the last bit, when the markup went up, interest rate went up, that's kind of intuitive. But what was not intuitive was that the platform attracted more people. So you would think that, this interest rate would compensate, but it wouldn't like overcompensate.
It does.
So why is that? I guess that's a bit surprising, I guess.
It is surprising. So I don't know. So what we know is that it moves up. We only show the markup from 0 to 10. It moves up and then it humps and comes back down. So it's not monotone, always moving up.
Okay.
And this might also depend on certain parameter constellations. So, but the ones we tried, it always moved up. So this interest rate effect is very, very powerful. It's always the case that the interest rate is very sensitive. So perhaps one thing, if you want to calibrate this model, you might say, to assume that the only lending comes from these guys on the platform is an extreme form. So essentially, we would say in China, all the lending goes through Alibaba and WeChat Pay, or Ant Financial. Of course, there's some other private banks and there's some foreign bonds that this might actually dampen the interest rate effect. So the interest rate effect is very, very powerful in this setting because we close the model this way. So we don't want to take it so seriously. I think what's important is that there is an interest rate effect, that the interest rate effect is so strong and powerful. We were surprised because that's the only financing arrangement. If you have some other financing through collateralized finance, all this will mitigate it to some extent. So if you were to write a model with all bells and whistles and collateralized banking, collateralized finance through banks and all this, the interest rate effect will be mitigated. And then you might get that if the markups go up, the eta goes down.
I guess in the endogenous markup, it suggests that initially there's like a win-win. You raise the markup, you raise the interest rate, you bring more people in.
Yes.
And at some point, it kind of...
No, but what happens is the output drops.
Yeah.
So you get more people in, but then the total activity, because of concavity of the production function,
I see.
they're smaller. Now I see Jonathan is here too.
Could I add to that? So there's two margins. There's an intensive margin and an extensive margin. The intensive margin is, given the platform I'm on, do I produce more or less? And there's a question of, do I switch platforms? And this depends on the elasticity of substitution across the different marketplaces, and it depends on the shape of the production function. So when you have this high interest rate going up, it actually really sort of dampens the desire to move away from the platform, but it has a big impact on output, right? Because you're facing this really high interest rate. So what you really adjust is the intensive margin on your platform. You produce less. You don't try to leave. And the platform internalizes all of this because it internalizes the goods market, and it thinks, well, okay, I understand that I can lock people in, but when they're locked in, they're really suffering with a high interest rate and they're not going to produce a lot. So there's not a lot of trade, so I can't get a big markup. So in that sense, there's no win-win for the platform. They face this declining profit.
Thank you.
Daniel, do you have any comments?
Yeah, no, a few, maybe one or two questions. So when we think about the optimal markup in the general equilibrium model, so that maximizes the profits of the platform. That's right. That's the goal. But if you think about that, okay, so the consumers they own the platform, so they all own the platform. But the terms of trade implied may damage the consumer. May lower their. So have you tried to do like the welfare? Because I'm thinking like when you show the graph of slide 32 where you have the monetary policy, so you could think of and there's one point where it's binding. It binds, and then you think about setting the optimal level for that to maximize the agent. You can have maybe a lower markup, but the terms of trade may be the effects on the terms that you have. I mean, it might be complicated. Just one thing occur to think. I come from monetary economics, so thinking always about optimal monetary policy. And I work for a central bank too, so it's kind of natural to think about this.
We haven't done really welfare.
Okay.
Perhaps, Jonathan, you can speculate beyond equilibrium or you muted.
Yeah, from a monetary point of view, the money here is really inefficient, Daniel, right? Because it requires a cash in advance constraint, whereas the ledger does not, right? So it's a classic monetary model. If you take out the ledger, it's cash in advance that creates a distortion, and so money is it's neutral in levels, but it's not super neutral, right? A higher inflation rate distorts savings and distorts the economy. And so in that sense, from a monetary point of view, moving away from the money and putting everything on the ledger is really good in terms of the payment system. The catch for the consumers is that the platform charges high markups, right? And this distorts production a different way. And so the optimal welfare would have to balance getting the better payment system against kind of having the platform kind of distort production with the markups.
Yeah, no, I understand. So, but I'm thinking because here the cash in advance, something like the Friedman rule, you would think would, I think it's not optimal in this environment because then you're crowding out the credit system.
That's right.
So
Yeah,
so that's
100%.
so you think for the you can fix the money friction by running the Friedman rule, but you hurt the credits. So and credit is productive. There's this productive technology. So that's kind of I think you would get something interesting. I'm not saying to do this papers, but I'm just thinking could be some interesting kind of.
Like here it would be. It sounds like here it would be push everything to the ledger and then tax the platform would be better than monetary policy. But assuming that these platforms don't cannot hide their dodge their taxes, I suppose.
It depends on how can you assume.
I think the big lesson here is you can't sort of think of monetary policy and sort of competition policy in the platform space independently, right? So if you had a really great tax system for trying to just prevent the platform charging markups and distort the economy, sure, move everything to it. But if you can't do that, then you have a different problem. And then the trade-off Daniel's raising is right, that actually you kind of want this set up, you can't perfectly regulate it. And if you run the Friedman rule, you actually prevent the platform from setting up this great credit system. So I think you're right that the desire for credit here does break the Friedman rule result.
Right, but Emre, your comment, but even if you push everything to the platform, only if the platform maximizes the ex-ante utility of agents, because there is always the effect on the terms of trade, even if maximizes the markup, so they can hurt trade, unless the objective of the platform is to maximize the ex-ante utility of agents. So it's not, see what I mean? It's not that clear.
100%, right. So that's the sense in which you can't isolate the monetary policy from the competition policy, because you have to change the objective function of the platform to get that to be a good outcome. So you can't. So they're very intertwined, right? So optimal monetary policy really depends on how your competition regulator has decided to deal with Amazon, or not deal with Amazon, as the case may be.
Right. Yeah.
But you're 100% right on the Friedman rule. This is an environment where the Friedman rule is broken by the need for credit, because so in a classic cash in advance or money in the utility, whether you have a good payment system has no impact on the amount of credit in the economy.
Right.
And even in the Stokely-Lucas 83, where they have the cash good and the credit good, there's a connection between them. It's just completely exogenous. Whereas here, the whole platform behavior endogenizes the ability to get the credit good. And so there's this tight connection between what happens in the monetary space and what happens in the credit space. And that's what breaks the Friedman rule here.
That's very cool. I mean, I like the connection to the Friedman rule. Thanks.
Yeah, so that's
Okay, great. Thank you. Maybe we can stop the